China's economy stalled in November, according to several key indicators, as worries about its property sector are back in the headlines. Data on Monday morning showed China's factory output growth slowed to a 15-month low in November, while retail sales posted their worst performance since the country ended pandemic restrictions 3 years ago. Home prices also fell further, and that matters because 70% of Chinese household wealth is tied up in property. The problems in China's real estate sector are back in the headlines too, as one of its largest developers, Vanke, is fighting to avoid a default. Well, Janet Moy is head of market analysis at RBC Brewin Dolphin. Janet, why are Chinese households so reluctant to spend?
As you mentioned, the Chinese property sector is still struggling. And you also mentioned that a large percentage of Chinese households own their own property. So you can imagine if you see your property prices falling, you basically feel that negative wealth effect. I think it is heavily impacted consumer sentiment as a result. And it is difficult to fix because it's been, quite a long time, a few years, since we saw this property downturn. And it seems that the bottom is still nowhere to be seen. So it is really hard to be very optimistic about the Chinese property sector at the moment, particularly even its largest property developers are suffering and on the verge of default. So in this environment, I think this low confidence is the key reason why households are so unwilling to spend.
Janet, China's factory output also looks weak. Is the country's strategy of reliance on exports running out of road?
It's interesting how despite this year tariff has increased, actually China's growth engine has been its net export. The reason why is because despite the fact that exports to US has come down, China has managed to export more to the other economies because of diversification. And I think this is important because we're now seeing that maybe even this driver of growth is faltering. And I think one reason is because global growth is just generally slowing down. And I think the issue is that domestic demand is weak. The property sector is weak, and now this external driver is also kind of potentially struggling after a pretty solid year. So I guess the thing is that 2026 outlook, it could remain quite fragile. And I think so far the authorities have been trying to restrain from stimulus or just providing a sufficient stimulus and maintaining a moderately loose monetary policy. And if this continues, it will lose this growth driver as well. Then I think 2026, they will have to have a more proactive fiscal stimulus.
So how might policymakers try and boost the Chinese economy in 2026? What are you expecting?
Yeah, I think I think one of the key reasons why the retail sales spending has slowed is because of that ending of the consumer subsidy. We had a very high base from last year, right? So I guess it's very clear to see that the consumers still need support when it comes to consumption, right? So I guess the Chinese government will have to work more on that, maybe have some new measures on consumer subsidies, just measures to support that consumer spending. And I think for the property sector, I think it is very hard, as I mentioned. I think they will want to prevent that moral hazard by directly bailing out property developers. So I guess that the stance is still maintain a moderately loose monetary policy while potentially more cuts in the reserve requirement ratio. But generally, I really do think that, so I think the government is supporting that innovation side of things, that new economy, that is doing actually quite well. If you think about AI, lots of companies are growing, the stock market there is growing. But I think still there is a lot of need for help with the consumption part, which I think it has to involve stabilizing the job market, providing hope that young people can find jobs, for example.
Briefly, Janet, China is still expected to stick to its current annual growth target of 5% next year. Is that realistic given the headwinds?
I mean, it's very hard to say. I think so far China has managed to achieve its growth target by flexing its policy muscle. So I think if they were determined to continue having this 5% growth target, they would have the appropriate policy support hoping to achieve that. So I would say I'm cautiously optimistic on China's historical ability to meet the expectation. I think the only year or so that they couldn't match the expectation is during COVID. That was a very tough period. So I think the Chinese government will have the flexibility to flex its policy muscle.
That was Janet Moy of RBC Brewin Dolphin. Don't forget you can watch more videos on Reuters.com.